Hello everyone. Salesforce dropped 20% yesterday after reporting earnings. Today I'm going to go through the news, the fundamentals, and why I think the market is unnecessarily pessimistic about the earnings and the company itself. I want to start off here with this CNBC article where they're talking about it dropped 16%. Now since then it's been about 23, 24% and even down lower today. So it's quite substantially down. But let's look at some of the things that are kind of contributing to this. So on the headlines here, obviously they fell short on the expectations of the market, and they also grew revenue, which ironically you would think would make it look good, right? That they wouldn't be dropping 20% almost. So if we come down here on the main points, earnings per share, right? So they reported 244 and 238 was expected, so they beat on that ironically. It's revenue here that's causing this decline. So they got 9.13 billion versus 9.17 billion expected, right? So that's one of the main reasons, or one of the main factors that's contributing to this decline in the stock price. If we scroll down here a little bit, here it says this is the first time since 2006 Salesforce fell short on revenue, right? So that's almost like 20 years. So maybe this is also contributing to almost the 25% decline as well. The fact that, it's been 20 years since they've actually not kind of grown or met expectations. So if we come down a little bit here, there's also a bit about the guidance. So they lifted their earnings forecast for this year for adjusted earnings of 986 to 994 a share. So that's a positive. Compared to 968 to 976 3 months ago. That's good. The revenue guidance remains the same, right, at 37.7 billion to 38 billion, whereas the analysts were looking for more than that, right? They're looking for over 38 billion, so that's also contributing, right? So it's kind of mixed guidance for the year. They're saying that they're going to beat on the earnings per share, but the guidance on the revenue is kind of the same. It's not accelerating much, and I think in the era of AI, companies are expected to perform a lot better because they're enhancing their products with AI. And we can see this with Salesforce, where they have Einstein. I think there's a mention here with Einstein is one of their products that they use for AI integration for their customers. Also a personal experience with this company. So where I work at the moment, we use it as a CRM, a customer relationship management. That's their primary product, Salesforce platform, SFDC. And I really think it's the positive about Salesforce is they have quite a good moat, right? So first off, it's very hard to transition from Salesforce to another CRM because you've all that data packed into one CRM. And I will also say a lot of their tools and systems are very useful, and the UI is very good as well for explaining things like sales, quotes, deal registrations, etc. Another thing is as well is they're not really leading, but they're with this whole Einstein thing, they really are starting to integrate a lot of AI into their products that will also increase productivity, which we're yet to see with a lot of CRM companies. And the final point is customizing and also integrating your system is a lot easier than other competitors. They have kind of a template is what I would say is of different objects and etc. And it's a lot easier to do development on them to suit your needs by adding different fields. For if we were to take an example of say a deal registration, where you could add in the date that it was done, the person that was doing it, the company that was doing it. So really good system. I would recommend their product is very good, and that's why I'm saying they're kind of being very overly pessimistic about this stock. But let's really get down to the meat and grit of it, and let's take a look at the fundamentals now. So popping over to the trading platform I use, we can see Salesforce here, ticker symbol CRM, has gone down substantially. So you can see reported earnings there on Wednesday. They were up at 271. They are now down and continue to go down to 218. So that's a substantial drop. So it's almost 24% in this weekly chart. So let's scroll down and take a look at some of their ratios. So their market cap is 262 billion, and their revenue is almost 35 billion. So quite a large company. Their PE is high, right? So a kind of a metric to look at here is PE. So their price is quite outpacing their earnings. Good PE is probably between 20 and 35. Earnings per share 544, and they have a slight dividend of 0.59%. On the dividend as well, this is a kind of a new feature for the company. They didn't really pay a dividend over the last 20 years. This is only coming in the last while. So that's important to note as well. That's probably one of the reasons why it's so low, and also maybe a contributing factor to why the company has been trading down, right? a lot of investors might want to see a dividend for this company. They're probably thinking that their return on invested capital might be better if they're not returning it to shareholders than if the company invested themselves. So if we come in here to ratios and we pop over to financial strength, so we can see their free cash flow was 9.5 billion. That's very positive. Their current ratio isn't the best, but it's, you know, kind of average, almost 1.1%. If we scroll down, their payouts, so there's no data on that because the dividend is new enough. If we come over here to margins, starting off with gross margin on the top, their gross margin is 75%. Over the last 5 years, the average is almost 75 as well, so that's exceptionally good. Their net profit margin is 11.87. That's pretty good as well. I would say it's amazing though. I mean, 12%. Especially when their gross margin is so high, and they're a tech company, a software company. And then their average over 5 years is 7.64, so that's not amazing either. But they're, you know, it's pretty solid. Their operating margin, 13%, positive enough. If we come over here then to growth, so their revenue change was almost 11%. That's very good. Per share growth over 5 years is 15%. Over 3 years is 21%. And revenue over 5 years is 18%. So this is all solid growth here. EPS over the last 3 years is 23.09%. That's pretty positive. Over 5 years, it is down though slightly. And I imagine that has a lot to do with their recent earnings report. We scroll down here. I want to look at net profit margins over 5 years, 6.45%. And the growth, that's, you know, decent enough. We don't have data on the dividend because it's new enough. And free operating cash flow, almost 30%. That's very positive as well. So if we come back here and we'll have a look at their financials, starting off with their income statement. If we pop back to 2021, what we want to look at here is their net income. So we want to see if this is growing. So 2021, we had 4.07. We were down substantially in 2022, 1.44. And down again in 2023, 208 million. And then substantially back up 4.14. So they made a pretty good recovery here. So from 2021, there was growth, right? And it's pretty good for this year as well. So positive there. On the balance sheet, if we close a few of these guys out, what I want to look at here is assets over the last 4 years. Are they growing or are they going down? So we had 66 in 2022, 95, massive jump there, 95, up again in 23, and then 2024, almost 100 billion. That's very good. And then liabilities in the same, are they going down or up? So 24, 37, 40, and 40. So they did go down slightly, so that's positive for this from 23 to 24. Another good metric to look at is their debt, right? So if we look at the most recent 2024, so their assets were almost 100 billion, and their total debt was 10. So essentially they could sell their assets and pay off the debt about 10 times over. So that's very, very good for the company. They're not overburdened by debt, and they're using debt to their advantage as well. So if we look finally at cash flow and come back to 21 and close these out, I want to look at just the net change first. So 2021, 2 billion, down 700, up 1.55, and up 1.46. So nothing really terrible there. If we really want to look at a good metric here, is the operating cash flow. So we want to see that going up over the years. So 4.8, 6 billion, 7, and 10, right? So they really are cranking out cash at a large margin. So that's very positive. So to finish up, I'm going to take a look at an interview with their CEO just to see their take on the drop and to see what they're talking about. NBC, we have Mark Benioff, who's the CEO of Salesforce, and we're just going to look a little bit at this to see what his response to the earnings are and the massive drop over the last 2 days.
Look, I'm not going to dance around it. The stock is down the most I've seen your stock down in a long time. But the cash flow numbers seem strong. I'm looking at the operating cash flow. I'm also looking at the Salesforce margin. They both seem within guidance. So I'm trying to, I need to rationalize why this is happening. Why have people decided that your business is definitively slowing right now, slowing?
I'm on the same point here, right, as Jim. I think the almost 25% drop is crazy. You know, their revenue was missed by a small bit, and their EPS beat, right? So why is the stock going down so much? I think it's really down to the guidance. The guidance was well above what it actually should have been, and the guidance didn't meet expectations, right? But let's just see what he has to say, Mark, here.
And that things are not as good as they seem.
Look, Jim, you can't always control the buying environment, but what you can control is your cash flow and your margin. And you can see the incredible growth this quarter is amazing. I mean, these are cash flow numbers that we've just never seen before, up 39% year over year to $6.247 billion in cash flow. Incredible. And you can see the margin is up 450 basis points to 32.1%. You know, this is a huge transformation that we've gone through over the last year.
So I think that's a really good reply, right? That's what we saw in the fundamentals, right? That the margin is up and their cash flow is incredible, right? I think it went from, I think this year it was like 10 billion, which was up almost 4 billion from a couple of years ago. So they really are cranking out cash. It's a very good point. Let's continue here though.
Year, and this has been an incredible moment for our company. I mean, these are cash flow numbers that are even larger than Coca-Cola.
Well, if that's the case, then revenue guidance of 920 to 925, it is indeed below the 9.34 guidance. Why is it below, given the fact what you just said?
Jim, we're holding our guidance for the year at $38 billion, which has been incredible for us. And what we see happening is not only this amazing transformation in our core financials, but also...
Yeah, so another good point there, right? So he's saying that they're staying with the guidance. They don't set the expectations. They met their guidance, but the expectation wasn't met. That's one of the reasons why the stock is down. So let's see if he has much else to say. He does kind of mention now about some of their customers, and that's what I want to finish up on, but let's just see what he has to say.
So the amazing AI transformation that we're going through as well, and you'll see some incredible new customer stories that are emerging with companies who are transforming themselves using our amazing new AI, including FedEx, Air India, and even Paychex. And I'd love to talk to you about that as well.
Well, let me just, before we get to that, I want to deal with this idea that things have gotten more competitive and maybe sales elongated. Is there something that I am missing, which explains why people are taking your stock down 17, 18%, when it to me looks like this is a rather just typical good Salesforce quarter?
Jim, this has been an amazing year for us. We've completely transformed the financials of the company, and you can see that we're, delivering, as I said, this incredible cash flow and margin number. So, look, I can't predict what the stock market does. You know that. Right. We've been through this how many times over a couple, I guess I've been doing this 25 years. But what I can tell you is that the most important thing remains the customer success, which is why how are we going to make these customers totally transform themselves, more profitable, better customer success using our incredible new AI technology. And that's what I'm really excited.
Okay, so
you can see he's really pushing the AI, right? Because it's a buzzword at the moment, with NVIDIA being the poster child and Apple and Microsoft and everything want to drive AI. So you can, it's probably a good sales point, right? But really, it doesn't really explain the 25%. I think you can't really explain it, right? It's just because the guidance is mixed and people are expecting, they're seeing the likes of NVIDIA and Microsoft massive gains, and they're expecting, things that are way outside the realms of normativity. So let's just see what he has to say about the customers.
Let's talk about what you're doing with FedEx. Let's put it out there about why someone selected Salesforce for one of the largest transport companies in the world. Why do they need you, and what are you doing?
Well, the opportunity of FedEx is incredible, and we've, of course, worked with Fred and Raj for years, but the idea now that we can really take their business to a whole new level of profitability and productivity is amazing using Salesforce Einstein. Now, Einstein is already delivering more than 1 trillion transactions a week. But when you look at our customers overall, the power is, with this new generative AI capability, we can take the 250 petabytes of information that's stored in Salesforce and action that to create another level of capability for our customers. And with FedEx, what that means is they're able to sell services to their customers that before they had tremendous white space with. And we saw that in the quarter with an incredible delivery of the AI capability with Federal Express. And the other one that I just mentioned.
Yeah, so on FedEx there, great customer for Salesforce to have. He's mentioned that they have petabytes of data. That's another kind of moat for them, that they have a massive amount of data that they can do AI on, they can do machine learning on, they can develop their company and their products based on that data. But FedEx, very good win there, and a very good thing to bring up with the interview. There's one final one, I think, is Air India, which is just kind of a side point, but let's listen to that as well.
Air India, This is an amazing next generation airline that has acquired all kinds of different airlines in India to create the leading airline in India. But when they did that, they had lots and lots of islands of information. But using our data cloud, they're able now to aggregate that information, and using this generative AI capability to get.
Yeah. So another product there is Data Cloud, which is in FSDC, the platform that Salesforce sell. And they're just highlighting how it's easy for customers to come over to their platform, especially when you have disparate sources of data like the Air India from all different companies. But India is also a growing market, which is a very positive sign for Salesforce to be in. But yeah, that's going to conclude our video today. I hope you enjoyed, and I'll catch you in the next one.